In this ISA 705, we are looking at modifications to the opinion. In order to form an opinion, we always have got to consider nature and severity, and that will lead us to the opinion. And based on that opinion, it would lead us to the basis paragraph. Nature, there are only two types. One is limitation of scope, and the other one is the financial statements are materially misstated. Limitation or inability to obtain sufficient appropriate audit evidence. Severity involves two things: material and whether it is pervasive. Materiality can be assessed three ways: material by dollar value, by impact, and by its very nature. So value is dollar value, and we're going to calculate a percentage. This is green materiality, linked to ISA 450. Material by impact is that if the adjustment turns a big profit to a small profit, or turn a profit into a loss, like in this case here, you've got the audit adjustment, only one audit adjustment, and the PBT before the adjustment was 100,000. That one adjustment was 90,000, and the PBT became 10,000. So a big profit became a small profit as a result of one or maybe two adjustments. The second one is the PBT before the adjustment is 100,000, and they had maybe one or two adjustments here. What I'm saying is it's only a few, yeah? And the audit adjustment here amounts to 140K. These are adjustments that we recommended, but the client didn't want to put it through. So the impact of that adjustment would have turned a profit into a loss. So when you have a situation where it turns a big profit to a small profit, or it turns a profit into a loss, it is still considered to be only material by impact only. It is not pervasive. You can also have another example here. If, let's say, the adjustment that we are recommending is going to turn a debt covenant to be breached, then that adjustment would be material. Nature here has got nothing to do with dollar value. So this one, no doubt, is talking about disclosure, but if you had a non-adjusting event that they did not disclose, that would still be material by value, because you need to calculate the materiality of the non-adjusting event. So what kind of disclosures are these that ignore the dollar value, like related party transactions, like material uncertainty disclosures? Those have got nothing to do with the dollar value. So you need to know what is the meaning of material by its very nature. Now, on the other side, you've got the word pervasive. So I want to go through this examiner's report, September 2020, that explains in beautiful detail about this issue of material and pervasiveness. So it says candidates are also expected to evaluate the opinion, which should be issued, and should apply the knowledge to the scenario in the question. If the candidate simply states that a pervasive misstatement will result in an adverse opinion, and a material but not pervasive statement will result in a qualified opinion, then they've not applied it to the scenario. So how will you apply it to the scenario? Under severity, we've got M and P. Make a comment on the M, make a comment on the P. So on the M, let's say the adjustment of 2.1 million is 15.9% of PBT and is material. The reason why I boldface this is because that represents the justification. Without the justification, if you just say it is material, you're not going to get any marks for that. The justification must be there. Similarly, when you're saying that something is pervasive or not pervasive, this one is the justification that on its own, because we're only dealing with that matter at the moment in the exam question, on its own, this is only one item and therefore not pervasive. So the examiner is saying here that if you're going to talk about material or pervasive, it has to come in the context of the scenario, meaning that you have to provide the justification from the scenario. So let's have a look at this. It says, candidates often seem to struggle with the concept of pervasiveness, which is an inherently judgmental area. ISA 705 describes pervasive as those misstatements in which the auditor's judgment are So these 3 bullets here are from ISA 705, that they are not confined to specific elements, accounts, or items in the financial statements. Not confined means not restricted. That means there are many financial statement items are either misstated, or many financial statement items where you cannot find the evidence. Then it says, if so confined, that means if not many represent or could represent a substantial proportion of the financial statements. Now, listen very carefully. The first bullet is about the number of financial statement items. Number. That's why when we were doing this sentence here, we said, on its own, this is only one item and therefore not pervasive. Can you see why we're writing this down? Because of 705. We need to talk about whether there's many or just one. If so confined, that means if it's not many, if it's just one, then it could represent a substantial proportion of the financial statements. Look at the second bullet. The word item is not there. The first bullet, the word item is there. Financial statement items. But the second bullet, there's no word items there. Okay, so what do you mean by so confined could represent a substantial proportion of the financial statements? So let's have a look at this. When is there a substantial proportion of the financial statements? Like, for example, failure to consolidate a subsidiary when it is a subsidiary. Sometimes management may not want to consolidate a subsidiary because maybe the subsidiary is making losses. So who cares whether the subsidiary has got lots of assets or not? It's going to drag down my consolidated profit. So I don't want to consolidate it. But you know what? Does it represent a substantial proportion of financial statements? Absolutely, because when you consolidate the P&L, the balance sheet, the cash flow statement, the notes to the accounts. Wow, just because you don't consolidate one subsidiary, there is an impact on a substantial proportion of the financial statements. Or consolidating a subsidiary when it's not a sub. So it's not a sub, and then you go and do things in the P&L and the balance sheet, the cash flow statement, the notes to the accounts. Oh my goodness, you're contaminating the whole financial statements there. Or you have got a discontinued operation and you fail to present the discontinued operation in the P&L and then the disposal group in the SOFP. Then it is affecting a substantial proportion of the financial statements, affecting the P&L, the balance sheet. Failure to prepare the financial statements on a breakup basis when the company is an ongoing concern. It affects everything. So when the company is an ongoing concern and you still prepare the accounts on a going concern basis, that is pervasive. Can you see that? Does it make sense? We're talking about substantial proportion of the financial statements. So the first bullet is about the number of items. The second bullet is not about the number of items. It's talking about whether it's affecting the financial statements. How many financial statements do you have? Well, you've got the P&L, you've got the balance sheet, you've got the notes in the account, you've got the cash flow statement. The third bullet on what is pervasive in relation to disclosures that are fundamental to the user's understanding of the financial statements. As far as we're concerned, the only disclosure that is fundamental to the user's understanding of the financial statements when there's inadequate disclosure of a significant material uncertainty. And these are found in ISA 517. If there's an MU, is there adequate disclosure of the MU? If it's yes, everything is fine. It's a blue box. If the answer to that is no, is it just an MU? Then if you don't have adequate disclosure, it will only amount to a qualified opinion because it's not pervasive. It's only MU. But significant MU, you don't disclose that, straight away adverse opinion because it's pervasive. So what's the difference between MU and significant MU? Let's go back to ISA 570 here. Supposing the exam question says management is seriously considering filing for bankruptcy. That is what we call a significant MU. So if management is seriously considering filing for bankruptcy, don't you think there should be adequate disclosure to the shareholders about this? There should be. So if you don't disclose their plans to shut down the company, that would be considered to be pervasive. So in order to come up with an opinion on the financial statements, you've got to consider whether it is a misstatement or limitation of scope, then go on to the severity, which is whether it's material and whether it is pervasive. and from there, you can choose your opinion. Still on the examiner's report, this is very important. An adjustment may turn a profit into a loss. The examiner is saying here that there seems to be a significant number of candidates who consider the definition of pervasive to be something that would change a profit into a loss. This is not the case in all circumstances. Quite often, a small change that converts a profit into a loss is due to a single specific element of the financial statement, just one financial statement item, and may not be considered to be pervasive. Now, I've got two different columns. One is pink and the other one is gray. So let's go and deal with the pink one first. On the left-hand side, you've got uncorrected misstatements, the audit adjustments that the client does not want to put through, impacts only a few financial statement items, maybe one, maybe two. In that case, it's only material, but not pervasive. It is material by impact, not pervasive. Let's go to the right-hand side, exactly the same thing, but the uncorrected misstatements may impact many financial statement items. That means that 90,000 here is made up of many items. There is no doubt you are debiting the P&L, but the credit, oh my goodness, the PPE is misstated, the receivable is misstated, so many things misstated. No doubt the debit side, the net effect is 90K, but on the balance sheet side, it's a nightmare. Then, in that case, it will be material and pervasive. So the key here to understanding whether it is pervasive or not, especially when you turn a big profit to a small profit or turn a profit to a loss, look to see how many items make up that audit adjustment. So sometimes in your exam question, this audit adjustment on the left-hand side is maybe only one or two items. Then it's material but not pervasive. But if you have got three different scenarios and all three are misstatement and it turns a big profit to a small profit or turn a profit to a loss, then maybe it's considered to be pervasive. So if you turn a profit into a loss or turn a big profit to a small profit, can it be pervasive? Yes, it can be pervasive. So you have to look at how many items are in the adjustment. We are also not just thinking about how many items are affected. We're also looking to see whether the area of the misstatement could mislead the users of the financial statements. So you can still have misstatements, but if it's not going to mislead the users in their economic decision making, then it's still not pervasive. But in your exam, one or two misstatements, this one, turn a big profit to a small profit or turn a profit into a loss, it's not pervasive. Three items, pervasive. Evaluate the implications for the auditor's report. It says year end is 31 March, now it's 1 July. During the year, Churney, a listed company, incurred costs of 1.9 million in respect of repairs to its plant and machinery. These costs have been capitalized and included in the financial statements. Your firm's audit work has identified that these costs have been accounted for as repairs, which would cause the company to breach a loan covenant. The directors have refused to amend the financial statements, which show a PBT of 1.1 million. But the adjustment is 1.9 million. So if that's the case, then it will turn a profit into a loss, right? Question. Now, can you tell me why it is not pervasive? Very good. It only affects one financial statement item. Excellent. So is it material? Yes, it is material because there's a breach of loan covenant and you turn a profit into a loss. Is it pervasive? No. Why? Because there's only one financial statement item. But what if this exam question said that there were 5 or 6? Then it would be pervasive. It will be material and pervasive. So it is important to understand that in the exam, marks are given for your comment on material. Marks are also given for your comment on pervasive. So you need to be able to know how to argue that out.